All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not financial doom porn for clicks. On January 27th, 2026, the National Association of Insurance Commissioners released data showing that insurer insolvencies increased 43% in the fourth quarter of 2025 compared to the same period in 2024. That same week, 3 regional property and casualty insurers in Florida and California entered receivership, affecting over 870,000 policyholders. This is not a crash. This is not panic. This is not a prediction about what might happen. This is what happens when an entire industry built on actuarial assumptions from a different era collides with climate volatility it never priced for, investment portfolios it can no longer sustain, and a regulatory framework that's already 18 months behind the crisis. Your insurance policy, the contract you've been paying premiums on for years, is not the guarantee you think it is. It's a conditional promise backed by reserves that are shrinking, investments that are underwater, and a state guarantee fund system that was never designed to handle simultaneous multi-state failures. The question is not whether this is happening. The question is how much time you have before your policy becomes a claim on an insolvent institution. I have watched insurance crises unfold before. The mechanics don't change. The names change. The specific trigger changes. But the underlying pattern of reserve depletion, investment losses, and regulatory intervention follows the same sequence every single time. And right now, we are in the early acceleration phase where the pressure is building faster than the system can adjust. In this video, I'm going to walk you through exactly what is happening in the insurance industry right now, why the collapse mechanism is already in motion, and most critically, what you need to do in the next 30 days to protect yourself from holding worthless paper when carriers start failing in clusters. By the end of this breakdown, you will understand the structural defects that make this inevitable, and you will have a clear action framework. So stay with me, because the window for preparation is narrowing every single week. Let me start with the foundational framework you need to understand, because without this, the crisis looks random. It's not. It's systematic, and it's been building since 2018. Insurance companies operate on what's called the combined ratio. This is the ratio of claims paid plus operating expenses divided by premiums collected. If the combined ratio is below 100%, the insurer is profitable on underwriting. If it's above 100%, they're losing money on every policy they write. For the last decade, most property and casualty insurers in the United States have been running combined ratios above 100%. They've been losing money on underwriting, so how have they stayed solvent? Investment income. Insurance companies take your premiums and invest them primarily in bonds before they have to pay out claims. The returns on those bond portfolios have historically covered the underwriting losses and generated profit. But here's the problem. When interest rates were at zero for over a decade, insurers were forced into longer duration bonds to capture any yield at all. They loaded their portfolios with 10-year, 20-year, 30-year treasuries and corporate bonds paying 2% to 4%. Then in 2022 and 2023, the Federal Reserve raised rates aggressively. Bond prices collapsed. A bond paying 2% issued in 2020 is now worth 60 to 70 cents on the dollar because new bonds are paying 5% or more. Insurers are sitting on hundreds of billions in unrealized losses in their investment portfolios. At the same time, claims are accelerating. Hurricane losses in 2024 exceeded $120 billion, the second highest on record. Wildfire losses in California hit $38 billion. Hailstorms, flooding, and severe convective storms are happening with increasing frequency and severity. The actuarial models that insurers used to price policies 5 years ago assumed historical loss patterns. Those patterns no longer hold. Insurers are paying out claims at rates 30% to 50% higher than their models projected, and they cannot raise premiums fast enough to catch up because state regulators' cap rate increases. This is the squeeze. Rising claims, collapsing investment portfolios, and regulatory restrictions on pricing. The combined ratio for the property and casualty industry hit 108.3% in the third quarter of 2025. That means for every dollar collected in premiums, insurers are paying out 1.08 in claims and expenses. They are bleeding capital, and the only thing keeping them alive is the hope that investment returns will recover. But investment returns are not recovering. They're getting worse, and the capital cushion that insurers rely on is eroding every single quarter. Now let me explain the mechanism that makes this not just a problem but a systemic crisis. Insurance is built on pooled risk. When you buy a homeowner's policy, your premium goes into a pool with thousands of other policyholders. The insurer uses actuarial science to predict how many claims will occur and prices the pool accordingly. This works when claims are statistically predictable and geographically diversified. But what's happening now is correlation. Hurricanes are hitting entire regions. Wildfires are destroying thousands of homes simultaneously. Hailstorms are totaling tens of thousands of vehicles in a single event. The geographic diversification that insurers relied on is breaking down because climate-driven events are creating synchronized losses across entire books of business. When claims are correlated, the pool doesn't just pay out more. It pays out all at once. And that creates a liquidity crisis. Insurers have to liquidate investments to pay claims. When they liquidate bonds in a down market, they realize losses. Those losses reduce statutory capital. When statutory capital falls below regulatory minimums, state insurance commissioners step in and place the company into receivership. This is not a theoretical risk. This is happening right now. In December 2025, Florida-based Lighthouse Property Insurance was placed into receivership after its surplus fell below the required threshold. Policyholders were transferred to the State Guarantee Fund, which is already underfunded by an estimated $4.2 billion. In California, 3 smaller carriers writing wildfire-exposed policies were declared insolvent in the first quarter of 2026. Their policies are now being administered by the California Insurance Guarantee Association, which has a claims-paying limit of $500,000 per covered loss. If your home was insured for $1.2 million and your carrier fails, you're only getting $500,000. The rest is an unsecured claim in a bankruptcy proceeding that could take years to resolve. And here's what almost nobody understands. The state guarantee funds are not pre-funded insurance pools. They are assessment-based systems. When an insurer fails, the guarantee fund assesses all the remaining solvent insurers in the state to cover the shortfall. Those assessments can be passed on to policyholders in the form of premium surcharges. So not only are you losing coverage, you're also paying higher premiums to bail out the failed companies. This is a doom loop. Failures increase assessments. Assessments increase costs for surviving carriers. Higher costs reduce their profitability. Reduced profitability pushes more carriers toward insolvency, and the cycle accelerates. We are in the early stages of this cycle right now, and the velocity is increasing. Let me give you the historical context because this has happened before, and the warning signs are identical. In the mid-1980s, the insurance industry went through a crisis triggered by asbestos and environmental liability claims that insurers had never priced for. Between 1984 and 1986, over 60 property and casualty insurers became insolvent. The guarantee fund system was overwhelmed. Policyholders in multiple states faced coverage gaps and premium spikes of 300% to 500% for those who could even find coverage. The crisis forced a fundamental restructuring of the industry and led to the creation of residual market mechanisms, essentially government-backed insurers of last resort. Those mechanisms still exist today. In Florida, it's called Citizens Property Insurance Corporation. In California, it's the FAIR Plan. These are supposed to be temporary stopgaps for high-risk properties that can't find private coverage, but they've become massive. Citizens Property Insurance in Florida now covers over 1.3 million policies, with total exposure exceeding $600 billion. The FAIR Plan in California has grown 150% since 2020. These are not capitalized like private insurers. They're backed by assessment authority, meaning if they experience catastrophic losses, every policyholder in the state gets hit with a surcharge. The second historical parallel is the savings and loan crisis of the late 1980s and early 1990s. Over 1,000 thrift institutions failed because they were locked into low-rate, long-duration mortgages, while the cost of deposits skyrocketed as interest rates rose. The mismatch between assets and liabilities destroyed the industry. The federal government had to step in with a taxpayer-funded bailout that cost $132 billion. The insurance industry is facing the same asset-liability mismatch right now. Long-duration, low-yield bonds on the asset side, rising claims and operating costs on the liability side. And just like the S&L crisis, the breaking point comes when capital reserves are exhausted and there's no private market solution. The difference is that the insurance guarantee system is state-based, not federal. There is no FDIC equivalent for insurance. There is no central backstop with unlimited resources. When the failures start happening in volume, the states will run out of capacity and policyholders will be left holding the bag. Now let me connect this to the broader macro environment because the insurance crisis is not happening in isolation. It's happening at the exact moment when the financial system is under maximum stress. Global debt levels are at all-time highs. Interest rates have been rising. Commercial real estate is in distress. Regional banks are sitting on unrealized losses, and consumer balance sheets are stretched. Insurance companies are financial institutions. They hold massive bond portfolios. They invest in commercial real estate. They rely on functioning credit markets to finance their operations. When credit markets tighten, when bond portfolios lose value, when real estate markets freeze, insurers get hit from multiple directions simultaneously. We saw this in 2008. AIG, one of the largest insurers in the world, collapsed and required a $182 billion government bailout. The trigger was not traditional insurance losses. It was derivatives exposure and investment losses that wiped out capital. The lesson from 2008 is that insurance companies are systemically interconnected. When the financial system is under stress, insurers amplify that stress because they are leveraged institutions with long-tail liabilities and mark-to-market investment portfolios. Right now, the financial system is under stress. Credit spreads are widening. Bankruptcy filings are accelerating. Commercial real estate valuations are collapsing. And insurers are on the wrong side of all of these trades. Their bond portfolios are underwater. Their real estate holdings are losing value. Their reinsurance costs are spiking because global reinsurers are pulling back from climate-exposed risks. This is a multi-front crisis and it's accelerating. Let me break down the 3 specific pressure points that are going to force the next wave of insolvencies. The first is reinsurance capacity. Reinsurance is insurance for insurance companies. When a primary insurer writes a policy, they typically cede a portion of the risk to a reinsurer to limit their exposure to catastrophic losses. Reinsurance prices are set annually during what's called the renewal season, which happens in January. In January 2026, reinsurance prices for property catastrophe coverage increased an average of 35% compared to 2025. In Florida and California, the increases were over 60%. Some reinsurers are refusing to write new capacity altogether in high-risk zones. This means primary insurers are either paying dramatically more for reinsurance, which destroys their profitability, or they're retaining more risk on their own balance sheets, which increases their exposure to ruin if a major event occurs. Both options are unsustainable. If insurers can't afford reinsurance, they can't write new policies. If they retain too much risk, a single catastrophic event wipes them out. The second pressure point is regulatory intervention that backfires. State insurance commissioners are under political pressure to keep premiums affordable. In response, they're denying or delaying rate increase requests from insurers. In California, the Department of Insurance has not approved a rate increase above 7% for homeowners insurance since 2022, despite insurers requesting increases of 30% to 50%. This creates adverse selection. The best capitalized insurers exit the market entirely because they can't price risk appropriately. The remaining insurers are the ones with weaker balance sheets, less reinsurance, and higher exposure. They're the ones that will fail first. When they fail, the remaining pool of insurers shrinks further, concentrating risk even more. This is the doom loop I mentioned earlier, and regulatory intervention is accelerating it, not preventing it. The third pressure point is the investment portfolio time bomb. Insurers are required by law to hold the majority of their investments in investment-grade bonds. These are supposed to be safe, liquid, and stable. But the bond market has been anything but stable. The Bloomberg Aggregate Bond Index, which tracks the broad U.S. bond market, lost over 13% in 2022, the worst year for bonds in modern history. Even though bonds have partially recovered, insurers that bought long-duration bonds in 2019, 2020, and 2021 are still sitting on significant unrealized losses. Statutory accounting principles allow insurers to carry bonds at amortized cost rather than market value, which means the losses don't show up on the balance sheet unless the bonds are sold. But here's the problem. When claims accelerate and cash is needed, insurers have to sell. When they sell, they realize the loss. When they realize the loss, their statutory capital drops. And when capital drops below the minimum, they go into receivership. This is not a hypothetical scenario. This is the exact mechanism that took down Silicon Valley Bank in March 2023. They had to sell underwater bonds to meet deposit withdrawals, and the realized losses wiped out their capital. Insurance companies face the exact same risk, and the trigger is claims acceleration, which is happening right now. So what are the 3 asymmetric plays in this environment? The first is self-insurance through liquidity and asset protection. If you cannot rely on your insurance policy to pay out, you need to hold enough liquid capital to self-insure against catastrophic losses. This means building an emergency fund that is not just 3 to 6 months of expenses, but enough to cover a total loss of your home, your vehicle, or your business without relying on an insurance payout. For most people, this is not realistic in absolute terms, but directionally it means increasing your liquidity position and reducing your dependence on insurance as the primary risk mitigation tool. The second play is geographic and counterparty diversification. If you live in a high-risk state like Florida or California, you need to understand that your insurance carrier could fail and your coverage could disappear overnight. The action is to spread risk. Don't put all your insurable assets in one geographic location. Don't rely on a single carrier, and don't assume that the state guarantee fund will make you whole. If you have significant assets, consider moving high-value property to lower-risk jurisdictions, using multiple carriers, and structuring ownership through entities that provide legal separation. The third play is hard asset allocation outside the insurance system. This is where precious metals and tangible wealth come in. If the insurance system collapses and the financial system is under stress, the assets that hold value are the ones with no counterparty risk. Physical gold and silver cannot be devalued by an insurance company failure. They cannot be frozen by a guarantee fund. And they cannot be diluted by monetary policy. In a scenario where insurance claims are not being paid, where financial institutions are failing, and where trust in paper contracts is evaporating, hard assets become the settlement layer. This is not about speculation, this is about preservation. Now let me give you the immediate action checklist because understanding the problem is only half the equation. First, you need to verify the financial strength of your insurance carrier right now. Go to AM Best, Moody's, or Standard & Poor's and look up your insurer's financial strength rating. If they're rated below A-, you are taking on counterparty risk that you don't need to take. Consider switching carriers immediately. Second, you need to understand your state guarantee fund limits. Every state has different limits on what the guarantee fund will pay if your carrier fails. In most states, it's $300,000 for homeowners coverage and $500,000 for total claims. If your property is insured for more than that, you are exposed. The action is to reduce your insured value, increase your deductible, or move the excess risk to a stronger carrier or a surplus lines insurer. Third, you need to increase your emergency liquidity. If your insurance carrier fails and your claim is tied up in receivership proceedings for 18 to 24 months, you need cash to rebuild, repair, or replace. That means holding more liquid assets outside the banking system. Physical cash, precious metals, and short-duration treasuries that can be liquidated immediately without taking a loss. Fourth, if you're in a high-risk state, you need to start planning for premium increases of 50% to 100% over the next 3 years. This is not fear-mongering. This is the mathematical reality of the actuarial adjustments that have to happen. Budget for it now. Build it into your financial plan. And if the increases make your property unaffordable to insure, you need to be prepared to sell or restructure. Fifth, educate yourself on alternative risk transfer mechanisms. Captive insurance, risk retention groups, and parametric insurance are all structures that allow you to bypass the traditional insurance market. They're more complex and they require higher capital thresholds, but for high net worth individuals and business owners, they provide control and transparency that traditional policies do not. The insurance industry is not going to announce the crisis in advance. Carriers will continue writing policies, collecting premiums, and issuing renewal notices right up until the moment they're placed into receivership. The regulatory agencies will continue approving rate filings and publishing solvency reports that lag reality by 6 to 12 months. And the mainstream financial media will continue treating this as isolated failures rather than a systemic collapse. By the time the crisis is undeniable, the asymmetric opportunity to protect yourself will have closed. You will be stuck in a guarantee fund process, dealing with coverage gaps, and paying emergency premiums to whatever carrier will still write policies in your area. That's why the action window is now. Before the failures cluster, before the guarantee funds are overwhelmed, and before the political response creates even more dysfunction in the market. Here's the question I want you to answer in the comments because I want to understand where you stand. Do you know the financial strength rating of your current insurance carrier? And if your carrier failed tomorrow, do you have enough liquidity to cover your exposure while the guarantee fund processes your claim? Let me know because the conversation we need to be having is not whether this crisis is coming. It's whether you're prepared for it when it arrives. And if you found this breakdown valuable, if it gave you a framework for understanding the structural defects in the insurance system and a clear action plan for protecting yourself, then I need you to do 2 things. First, smash that subscribe button and turn on notifications because this channel is dedicated to connecting dots that the mainstream financial media will not touch. We go deep, we go early, and we focus on actionable intelligence. Second, share this video with anyone who owns property, runs a business, or relies on insurance as a risk management tool. They need to hear this. The crisis is not coming. The crisis is here. The insolvencies are happening. The investment portfolios are underwater. And the regulatory system is already behind the curve. The only question is whether you're going to recognize the warning signs and act while you still have optionality, or whether you're going to wait until your policy is a claim on an insolvent institution. Take action, stay informed, and I'll see you in the next one.